Our next speaker is going to be Professor Jonathan Parker. Jonathan is the International Programs Professor in Management and a Professor of Finance at the Sloan School. Professor Parker has held numerous government service and consulting positions during his career, including Special Advisor on Financial Stability for the Office of Financial Stability in the United States Department of Treasury. He currently serves as a co-editor of the NBER Macroeconomic Annual. He's on the board of editors of the American Economic Review and on the American Economic Association's Committee on Economic Statistics. He is also a research fellow associate at NBER. His current research includes the efficacy of recent policies, including economic stimulus payments and the Cash for Clunkers program. Please welcome Jonathan.
I think I'll use. So thank you very much. Like Adrian, I'm not used to events like this. This is actually my first year back at MIT, which is very nice to do. And previous alumni events I've been involved in didn't occur in a fancy room with nice tables and applause and a very nice introduction. So I'm feeling like I should be starting out by thanking the Academy, but I'll just thank MIT for bringing me back. So this paper is really a little bit, let me give you a little context first for what I'm going to describe to you, some of my research. Some of what we're doing in the Sloan Finance Department is building up an expertise in both research and teaching related to household finance and consumer financial products. And this involves better understanding at the household level what actually individual investors, consumers, savers are doing within their consumption, savings, and portfolio choices. There's a long history in finance of studying corporate finance, the balance sheets of corporations and what they're likely to do, and using those studies to try and understand better how to price the claims that come from the corporate sector, corporate stocks, corporate bonds. And the household sector is not that dissimilar. There's a vast amount of assets out there that are claims on the household sector. They are obviously mortgage-backed securities, securitized auto loans, securitized credit card debt. And so part or one of the dimensions in which household finance becomes very important is in understanding how it's likely to price those claims, because to do that you need to understand the household behavior, how the households are going to come at the problem of when to pay, how to pay, what sort of factors lead them to run out of liquidity, the same way you might be concerned about what sort of factors lead a firm to run out of liquidity. A second source of reason that we're doing that is because the household sector is the subject of renewed and intense policy debate. Much the way we regulate corporations and corporate financial decisions and have accounting rules and the like for that, we are now regulating lots of ways in which consumer credit and marketing of financial products to households proceed. To better design those sorts of regulations, to make the market as efficient as possible for the investors or the corporations and firms that are providing the credit, as well as for the households using the credit, we need to better understand the sorts of decisions that households make and how they make them. And that's really the reason. So this paper that I'm going to talk to you today about, this research project, is sort of tangentially related to that. But that's kind of where we're coming from. So what I'm actually going to talk to you about is really a paper that's not quite perfectly on finance. It's more about understanding the household consumption decision, what I think of as a fun, interesting, and policy relevant and kind of important piece of recent US economic history. So what I want to take you back to is late 2007 and early 2008, and to the Economic Stimulus Act of 2008. So if we can remember, the recession that hit the US economy started in December of 2007. And Congress and the administration acted rather quickly to confront the recession. So along with the Federal Reserve cutting interest rates, the Economic Stimulus Act was passed in February of 2008. And it was a $150 billion package. Now again, you have to kind of go back in your mind and remember what it was like in 2007 and the first half of 2008, when $1 billion was considered a lot of money. After the third quarter of 2008, of course, the trillion became the new billion. But at that point, we had $150 billion in economic stimulus. 50 billion of that was incentives to encourage firm investment. And the other 100 billion was economic stimulus payments sent out to households. That's a picture of an economic stimulus payment here. So the big question is really what happened when they sent out those economic stimulus payments. And so what I'm going to talk to you today is how we kind of know or can learn about what that program did for the US economy. And so the fundamental question we'd like to know the answer to is, did the economic stimulus payments help to maintain the spending and the economy when they went out and shortly after in 2008? Now, I don't mean to kind of spoil the ending here, but you'll also remember that there was a rather large recession that followed this shortly. So in some sense, the answer ex post is, wow, that may not have been a good idea. But that's not really the deep question we're after here. Was this or was this not the right thing to do at the time? The question we're after here is, how does this tool work? If the government's going to do this in the future, how are households going to respond? Because there may be future times and future events when this tool may be useful and policymakers may want to consider it. And the more we can equip them to understand what it does, the more likely they are to make the right, hopefully the more likely they are to make the right decisions or the better decisions. Okay. So let's try and remember, let's go back to, there we go, to where we were at the end of 2007 and 2008. So here's what I've just plotted here is just real gross domestic product and real total personal consumption expenditures as indexes, indexed to 100 in the fourth quarter of 2007 when the recession began. And for some reason, this graphics program didn't really line up the dates very well with but here, whoops, where's my, I need to know where my laser pointer is here. Nope. Any clues? Top, but let's try this. There we go. Okay, so that's December 2007. And so what you see is sort of some initial, over the first few quarters, declines in GDP. And then, of course, here is the third quarter, and then the fourth quarter is a sudden collapse. So we had minus 6% annual growth rates over a couple of quarters. And this is, of course, during the fourth quarter that everything goes Lehman fails and so on and so forth. So, but up until that point, this was a reasonably mild recession, and consumer spending actually stays quite strong through this period. Now, you could take two views, so we could take two views of this. One is that the economic stimulus payments went out, and that's great. Not much happened until the Wall Street banks started toppling over like drunk frat boys at a fraternity party. Or you could take the view that the economic stimulus payments were sent out, and then what happened later was just a disaster to the economy. And that's really the inference problem that we've always faced in studying fiscal policy, especially fiscal policies aimed at households. Fiscal policy or stimulus policy tends to be tried when the economy is going downhill, and so it tends to precede bad times. And you could argue, well, that's just the way it is. Then the fiscal policy is doing a lot. It's heading off a lot worse recession, or fiscal policy is completely useless. And of course, at this time, you probably read plenty of people telling us that we had to be spending an order of magnitude more, or that every single dollar we spent was a complete waste. Right? Plenty of people out there on both sides of the coin, and the hope here is to provide some more social scientific discipline for these debates so that we at least understand some of it. And the heart of that problem is really understanding what the counterfactual would have been had we not done this. Another thing to keep in mind is that this recession sort of wasn't expected to be a very big recession when this policy was introduced and proposed and passed. In 2001, we had a stock market decline that was quite significant. If you add up the amount of wealth that the US economy lost at that time and contrast it and compare it to the policies that were pursued, and what you have is coming out of that is a very small recession. The sort of recession that we remember, especially if you were long in the tech stocks at the time, you remember it very vividly. But otherwise, you think as a recession and unemployment rate and those sorts of perspectives, this was a very small recession. So the policymakers were comfortable in thinking that if this were to happen again, we'll pursue the same set of policies and we will not have a severe outcome. It, of course, was wrong, but it was not wrong because of the calculations. So why was that wrong? Partly that was wrong because of the calculations they were doing, which suggested that we had a similar sort of loss of wealth at risk. So if you calculated the amount of money that we might lose on all mortgage-backed securities, where we're thinking of, say, a 50% default rate on subprime and a recovery rate of 50% and a bunch of defaults on Alt-A's and a recovery rate there, you came up with numbers like $500 billion, big numbers, but small relative to the amount of money that the stock market lost prior to what was the 2001 recession, leading one to believe that the similar sets of policies, small fiscal stimulus, small monetary policy, was likely to succeed. Of course, it didn't. The other thing I'll just point out is I have a graph here with a couple of series. So here's the stock market at the time. And this is relevant for thinking about whether household spending was being maintained or not, because one of the things that the household looks at when they decide spending is what's happening with stock markets. And so the stock market is sort of stable. As we know, there's a bunch of credit market disruptions and bad news in 2007. And then in 2007, it starts not monotonic, but a decline that, again, becomes very rapid when Lehman fails and the government has to step in and insure a large number of institutions. Interest rates is the dashed red line, so that's the 3-month Treasury bill. Again, a steady decline. Now this kind of monetary policy responding to some extent to the weakness in the economy. It comes down from sort of 4 or 5% throughout the beginning of the recession to about 3% and then drops to 0 where it's been close to ever since. So back to our main question. Did the economic stimulus payments, was this useful? Did it raise consumer demand at that time? Or did it help support the economy? Or was it just money wasted? And how it's money wasted is that we send out checks to people and then we tax them later in a manner that's likely to distort their behavior. So we're doing distortionary capital gains tax, we're taxing labor income and reducing effort. So one might have seen this policy, and indeed many people did, and said, what a waste of money. We're sending people lump sum checks, we're going to have higher taxes in the future. This is just the sort of bad economic policy you can pursue. And then of course there's Paul Krugman, who cites the general theory and says we need to spend $1 trillion more. My copy of the general theory doesn't have the quantitative tables in the back when I look up size of crisis and try and see how much government spending should follow. But I've looked a couple of times, and maybe I need to look on Amazon for his copy. We didn't have much guide. The economic stimulus payments of 2008, however, are going to give us a whole bunch of information. And the key here is that they're going to allow us to estimate a counterfactual, what would have happened had the stimulus payments not actually arrived. And I'm going to be very clear on this later at a couple of points. I don't mean an aggregate economy counterfactual, because in this aggregate economy question, they did this policy and there's no direct way, just from the data, to infer what would have happened had the policy not been passed. But we can see, did households turn around and spend this money when they got it? And the way we can do that is because the government did something very nice for me. They randomized this policy effectively. How did they do that? Because they distributed the economic stimulus payments in the timing of it in accord to the last 2 digits of Social Security numbers. Why did they do this? Well, it's too administratively burdensome to distribute the checks all at the same time. It's just not feasibly possible. We're talking about close to 100 million payments to people. So they had to spread it out over quite a number of weeks. That doesn't seem fair. Some people are going to get theirs before other people. Well, that's where almost randomization comes in. They say, okay, fine, we're not going to pick and choose, so people in my district get it before people in your district, for example. That could have happened. Instead, we're going to key it to the last 2 digits of Social Security numbers. And I don't know if you know, but the last 4 digits of Social Security numbers are assigned sequentially when you apply for them. So most people's were determined when they either first came to the country and applied or first were born. So that's way early. And in fact, if you wanted the particular last 2 digits, they assign it sequentially in a pile of mail. There's no way to pick it. So it's darn close to random. And so the strategy we're going to use to try and identify whether people spend when they get their checks is to compare the spending of households who get their checks early in this program and see if it jumps relative to the spending of households who get their checks late in the program. And then the same thing at the end. Did people who got their checks at the end then have their spending jump up to higher levels when they came? And from that, we kind of have an implicit counterfactual. It's like a medical experiment. Some people are treated early, and other people are treated late. And we see, did the spending of the people who are treated early recover earlier than the spending of the people who were treated late? So let me walk you through a little bit of what this research program was about. Actually, let me first flag the media in their infinite wisdom. When the law was passed, there's a whole lot of speaking about it won't work. Consumers not likely to spend their tax rebates. Here we say consumer spending. They called up a bunch of people and they asked them, are you likely to spend? And only 15 to 38% said they would spend them. That's a pretty big range. And at least they're honest. You know, the media says, granted, some of the surveys were not scientific. The Turbo Street Tax and Wall Street Journal polls were based solely on people who responded to online polls. Okay, so i.e., we're writing an article, but really we don't know what we're talking about. So my goal is to give them some better information so the next time they know what they're talking about. Then the checks start to go out, and the media immediately concludes, fantastic, it's working wonderfully. Stimulus-fueled consumers flock to discounters, and in fact, information I still can't get out of the data, they're going to tell you which retailers are winning and losing based on the latest blips in sales. And firms respond. So here's a coupon from Restoration Hardware that actually has nothing to do with the actual stimulus program. It's just a coupon for $100, but the marketing is tied into the idea that households might have cash on hand and might walk into a Restoration Hardware and spend their $950 check on a faucet or a, okay, maybe a dish towel. Okay. So I did 2 studies on this. One of them is joint with Christian Broda, who works at Duquesne Capital. And we use the Nielsen Consumer Panel. So Nielsen, amongst the many things they study, they have a panel of households in the United States whose spending they track. They give them barcode scanners, and when they come home from shopping goods for a narrow range of household goods, they scan in the goods as they take them out of their supermarket baskets. Why did they do this? Well, I can tell you what Nielsen says. I'm not sure why they do this. One reason is that they will then influence the decisions that producers make and the products that are produced. So if they like a certain product and they buy it, they get to, the retailer, so the producer, gets that feedback. And they also have a survey technology where they give households surveys. And they can respond to the surveys. What is it you liked about that product? What didn't you like? And again, that allows them to influence the products that are actually delivered to them. So it's kind of like rating movies or online ratings. You get to give feedback to producers. The second reason is when you do this, you win valuable Nielsen points, which are useful for prizes. So you can have a little collect hair dryers and the like by collecting consumer points, Nielsen points. So the advantages, they actually are running this on, at any one point in time, actually over 100,000 households, but there are about 60,000 that during any given year report their spending regularly and with enough frequency to be considered regular reporters. This is an example over here. Oops, let me back up, of the sort of the scanner that they were given at this time. There's now smaller, fancier versions. And they were just, okay. So the advantage is there's a lot of households. This is a pretty big survey. They're scanning in real time. And the disadvantage is there's a small slice of spending that are covered. What we did is we contracted and paid Nielsen to run a survey of these households that asked about the economic stimulus payments. And so about 3/4 of the households we could do this online because that's how they responded to Nielsen. The other ones we had to mail paper copies to, which they scanned their responses in with their barcode scanner. So we asked them, did you get an economic stimulus payment yet? They had a bunch of answers. If they said yes, then we went on and they would respond in what month did you receive the rebate, what day, how much was it, and what did it come by check or direct deposit. Okay. So that's one data set I'm going to use. I'm going to show you results from that study. The second study is with different co-authors, Nick Soulelis, who's at the Wharton School, and a couple of other government economists, David Johnson and Rob McClelland. But for that, we use the Consumer Expenditure Survey, which is a survey run by the Bureau of Labor Statistics and the Bureau of the Census, which underlies the Consumer Price Index. So they go out and they ask households about all of their spending in very detailed categories. And that's extremely painful if you ever have to walk through it. It's being completely reformed, I think, because of the pain inflicted on consumers in this, so there'll be a new consumer expenditure survey in a couple of years. But for now, it takes 4 hours to do this. It's an on-site visit, laptop assisted, and sometimes there's revisits. So it's kind of a painful thing. Fortunately, households, when you're selected into this, well, fortunately or unfortunately, 4 times. And they're retrospective 3-month spending. And households come into the survey every single month. So we have monthly variation, which isn't as good as our Nielsen data because the checks went out at a weekly frequency. And there's only 5,000 households. But the advantage is they cover all their spending, and all is in quotes because it's not really all, but it's much better than the Nielsen data in terms of the breadth of the spending that it measures. And again, we did something similar. We ran a survey asking them, I won't spend much time on this having mentioned it for the other one, last year you got an economic stimulus payment different than a tax rebate. Have you gotten a tax rebate? What month? What was the total amount? And then we actually asked who was it received by, and left the possibility of households getting multiple stimulus payments, which many did. Okay, so I'm going to now present to you the findings of each of these studies, the one first using the Nielsen panel data, and then the consumer expenditure survey. And then I'll come back and I'll add them up and show you what it means for the macroeconomy. Did this stimulus spending raise demand, cause more consumer spending? So this is, how do we do this? Well, we're going to simply, it's really kind of a simple methodology because of the randomization that's involved here. It's simply a matter of comparing the spending of households week by week. So the first thing we do is we run a regression with dependent variables, either the total amount spent during a week, the percent of spending relative to the spending in the first quarter of 2008, on the explanatory variables, which are the average spending of everybody in every single week in the year. So that whenever spending is going up in aggregate or down in aggregate, that's out of the picture. And now we're just going to see whether the spending is high relative to what everybody else is doing the week before you get your economic stimulus payment, 2 weeks before, the week of, the week after, 2 weeks after, so on and so forth. And so each of these columns in this table represents a different regression of that form. So the first thing to notice is that the contemporaneous week spending jumps up. So the first column has a dependent variable we're explaining the dollars of spending in a week on Nielsen goods. And that Nielsen goods are about $90, $100 a week that they're reporting on average. So there's a $13 jump in that slice of spending the week that the economic stimulus payment arrives. That's about 10% of spending, roughly. It's a little bit less, but in a percent of spending regression, that second column, that says that's a 10% increase. And it's not a big slice of the economic stimulus payment because we're only studying a small slice of spending. It's about 1.4% of an economic stimulus payment. The second thing to note is that there's very little evidence of spending before the payments arrive. I'll come back to that. Okay, there's very little evidence, at least the week or two before. It really is the week it arrives. The third thing to note is that actually that spending isn't just a one-week phenomenon. It continues over time. So there's $13 the week it arrives, $9 the week after, $3.6 the week after, $2.8, headed down to 0. Similarly, 9%, 8%, 3%, so on back to 0. So that after 7 weeks, this is definitely being a little stubborn for me. After 7 weeks, we have $30 spent. We have about 4% higher spending over those 7 weeks, or just over 3% of a stimulus payment on this narrow slice of goods, quite easily detected. Okay, so that means that there's a bunch of spending. What is it, big or small? I'll come back to that. Next, we tell you that we find something similar looking at the consumer expenditure survey. So the consumer expenditure survey, this is a slightly different format for the table, but it's the same basic regression. What I'm not looking at is the weeks before, the weeks after. I'm looking at the 3-month period in which it arrives. And again, because households are entering the survey every month, we kind of have monthly variation instead of weekly. So the first thing to we're also going to try and look at spending on food, couple of measures of non-durable goods. Let's focus on the total spending. This 0.5 number says that the 3 months in which the economic stimulus payment arrives, spending on all goods that households have rose by about 50% of the economic stimulus payment. So the average stimulus payment is about $950. So we're talking about $475 of additional spending, roughly. If I look at but those two circled lines, the other specifications, let's see, are we gonna get this? There we go. So this is the percent change. Over the 3 months, we have a 3% increase in spending, or what I just said from the other lines was 475. If I actually try and explain the dollar amount of spending on a variable that's sort of 0 if you don't get a rebate, that 3 months, 1 if you do, you find a $475 of additional spending. So the first lesson of this is, yes, households turned around and spent a bunch of this money. Far from all of it. Okay? That's interesting from the policymaker perspective, and I'll come back and add that up for how big it was shortly. But it's also interesting from a consumer finance or household behavior perspective. So Franco Modigliani and Milton Friedman are kind of the pioneers of the basic model of household behavior, which is households ought to look forward, think about their total lifetime resources, and set their spending in accord with that. And this is a wildly different picture of behavior. This is no, I don't do that when the stimulus program is announced. I wait until the check shows up. And then I don't think about that check as a contribution to lifetime resources, and so spend a tiny bit from now till I die. I'm spending majority of it, or at least half of it, when it shows up. Okay? Now, you know, that doesn't sound like what Franco Modigliani was originally talking about when he thought about this, because he was thinking about life cycle behavior. I know that when I retire, I'm not going to have income, so while I'm working, I'm going to save income. I'm going to think about my total lifetime resources and my total lifetime need for spending, and I'm going to smooth my consumption over that. So when I get a few good years of high earnings, I'm going to save more, and when I have a few years of unemployment, I'm going to save less. Right? Dis-save for that. And then when I'm retired, I won't have no money because I spent it when it arrived. Instead, I will have saved a lot of it to support retirement. Well, you can see that in Franco's model, messing that up leads to starvation during retirement, or living on just Social Security, whether it's there or not. It determines whether you starve or not. Those are big questions with first-order import for the household getting it right. If you get a $950 check and you spend half of it, it's kind of a small issue for your lifetime welfare. Whether you go out to an extra dinner or go away for the weekend to an inn, these are the sorts of questions. And smoothing that over the years is a much smaller issue. That said, it can still be a very big issue for the macroeconomy. Because if everybody at the same time acts to cut spending or increase spending, it's a macroeconomic factor, and it leads to recessions and booms. So we're back to some of the issues that Andy kind of talked about. What is it that coordinates household behavior? How is it the behavior actually gets acted out? And when is it that everybody's moving in the same direction? Here's what happens when I add up the Nielsen data. I have to do, there are 3 different lines here because I've used 3 different methods to try and scale up the narrow measure of spending that Nielsen measures to something that's equivalent to all personal consumption expenditures. So the blue line is the nominal now. I showed you the real earlier. This is just the dollar amount of spending, total aggregate US personal consumption expenditures. And you can see that the actual amounts, sorry, once again, this is the 4th quarter of 2007, consumption spending is actually rising up to the 1st quarter of 2008. It actually rises throughout the summer in dollar terms, flat up to the 3rd quarter, and then plummets into the 4th quarter of 2008. So that's very low. If we didn't have the stimulus payments, these are 3 estimates for how demand would have been adjusted downward. Okay? A substantially different picture for the summer of 2008. This is not the complete picture. All I'm doing here is taking the distribution of payments that I can collect from the Treasury Department and applying the spending propensities that I've estimated at the household level. So this omits an awful lot of effects. One effect could be that you think, okay, the government is willing to do whatever it takes. So I'm going to get confidence, I'm going to have more confidence, I'm going to spend more. Okay, that could be an effect. Had this not happened, that would be omitted from this graph. It could be that, again, I saw the government do this and I thought this stupid government will spend at the slightest drop of a hat. It's going to need more taxes in the future, and I have lost confidence in my government entirely, and I am going to cut my spending and consumption less. That's not in this picture. More tied to what we think of as kind of modeling and understanding this behavior, it could be that when everybody went out to shop, prices rose. So that is, the additional consumer demand crowded out other forms of spending by firms, for example, just ends up in prices and interest rates, pushing up interest rates. And so it doesn't actually raise aggregate demand. And in a boom, most economists would think that that would probably be the effect of such a policy. Right? Economy's humming along, everybody's going well, the government sends out money. If people turn around and spend it, that just makes conditions tighter. Prices go up. That's not a good thing. In the recession is where economists will tend to differ. Is there a multiplier here? We're in a recession. People are going to go out and spend money. Are they putting slack resources to work so that when I spend my economic stimulus check at Home Depot, it keeps the employees at Home Depot in work, and the people who made the wrench and the hammer that I'm buying, it keeps those factories running, which keeps those people in work, which keeps them spending, which keeps other people going. And that's the kind of the question that's a little outside of this scope. Okay? That said, what we have informed the policymakers of is that people will turn around and spend this. A natural alternative that they might think about is the government spending it itself. Right? So that's one question. And so the people who thought you should spend, rather than give the money to the households to decide how to spend it, now at least they know that if you give it to people to decide how to spend it, they will tend to spend it. They won't just sit on it and save it. The Consumer Expenditure Survey gives a roughly similar picture. I won't go through it. There's slightly different specifications here, and there's a purple line which takes seriously many lags of the data beyond what are statistically significant. But you get the idea. Consumer demand supported during the summer of 2008. We learn a couple of other things. So let me pause. So in one sense, the stimulus program worked. So households did spend a bunch of this money within a few months of receipt. And the demand for consumption was aggregate important. So this is the numbers that compared to what I just gave you. 1% higher personal consumption expenditure, 1% to 2% higher in the second quarter of 2008, and 0.5% to 1% higher in the third quarter of 2008. Big questions. I just said, was there a big consumption multiplier? That we don't know. Let me also just kind of come back to the should question. So a lot of economists, especially when they get talking about policy, will say the government should do this or the government shouldn't do that. And in order to get on TV, you have to sound not only say should, but you have to be incredibly confident in your should. You can't say, well, on balance, the arguments suggest that they should. You have to say it's absolutely the case that they should, or the US will drift off into the Pacific and sink, or something like that. That's absolutely not the social scientific approach that we try to pursue in research in general. So our arguments are specifically tied to careful statements about causation. And so what we're trying to do is measure. We can tell policymakers, if you pull lever A, you'll get effect B happening in the market. Right? This is how, if you change this, the economy will respond. Markets will adjust, prices will change, returns will differ, households will behave differently. That is the scope and central exercise I see academic, financial, and economic research doing. The should requires a welfare statement, which really requires now bringing some sort of moral philosophy in view of how to weight the utilities of the winners and losers in any given policy, and a great deal of confidence in your model of that. Okay, so some people have that, and indeed some people have to get out there and make those decisions, but the social scientific content of economics and finance does not provide those tools. And that's a pet peeve of mine that people who get out there pretend it does. You certainly have to make those decisions, and you have to make those cases, and you're bringing to bear a lot of arguments when you do that, but social science doesn't tend to be much help there. So the stimulus program worked, but of course it didn't work because we had a massive recession. And I don't think that the massive recession invalidates the use of the policy, and certainly it leaves open the question as to whether the policy should be used next time. So I'm running short on time. Let me give you 3 more things that we also learned. Who spent? I could look and stake out just households that have low income or low assets. They do the majority of the spending. They spend at much higher rates than the typical household. That's not surprising if you think about it. Another question is whether that media survey had any real content to it or use at all. So if you call up someone and you say, the government's sending out economic stimulus payments, will you spend it? Or you've gotten one, did you spend it? You can see that's kind of a hard question to answer. So if I took my stimulus payment and it was a check and I signed the back of it and sent it into my checking account, I might think that I saved it. But 3 months later, I might have been buying a car or something and looked to see what the balance was in my checking account. and decided to get the sports version or the extra whatever it is and spent more. And that causal effect then is very hard for me to parse. You know, what is it that makes me do what I do? Sometimes I don't know myself. And so it might be that that's a pretty empty question. But it turns out to have a lot of information, although to be imperfect. So what it's very good at is the people who say, I spent it, spent it. We find nearly 100% spending response amongst the people who respond, yes, I spent that stimulus payment check. However, the people who say that they saved it or spent down debt still spent a significant amount of it. So that's kind of where we stand there. So there is information in that, despite the media's mocking themselves even as not being very scientific. Well, the sampling frame is ridiculous, but the question approach is not terrible. I also look to see whether people spent when the program was announced, and people learned about it at different times. So I could run a similar analysis to what we just did, and we find no noticeable spending effect on announcement. It really is, all of the spending is going to occur when the money actually gets out there. So it's not enough in terms of generating spending to just announce the program, although when you announce the program, you're going to change everybody's expectations of spending in the future. So firms may not fire workers thinking when those checks go out, we're going to have sales. Okay, so to conclude, I've already given you my pet peeves on social science. We are trying to bring scientific discipline to policymaking. We can provide tightly estimated, well-identified causal effects of policies so that policymakers, when they do the policies, know what they're doing. Washington can still fight as to whether it's the right thing to do or not, but they shouldn't fight about whether this stuff is going to get spent if they send it out next time. And that's partly because this policy was almost unique historically. We don't get policies from the federal government that usually randomize across people. And so it's a phenomenally useful and unique experiment that allows us to understand how it is that these policies actually go out there and impact the economy. So, and then the last bullet here is just, you know, we know that households spend a good chunk of this, now around half, and the policymakers now have this tool. Let me stop there and again open the floor for questions. Yes? Well, it's actually just, I'm supposed to make sure we get our microphones.
That $950 you spent on a dish towel at Restoration Hardware or a drill set at Home Depot, wasn't the dish towel woven in Bangladesh and the drill set made in Japan?
Yeah, we don't know what the trade impact of the total product was. So one assumes a reasonable guess would be it's got the same proportion of imports as the usual consumer bundle, which is significant. So the personal consumption expenditures, roughly 2/3 of GDP, imports roughly 25%. So somewhere around 1/3 of that is going abroad. So yeah. And I mean, there's the retail sector slice obviously stays here, but another 1/3 goes abroad. Pat, actually, Pat, I'll let you.
You mentioned that consumers did not spend all of the checks that they received. And my question is whether the behavior that we observed was consistent with what our previous models were in terms of consumers' marginal propensity to consume, and whether you were surprised by what you saw, and whether we think that relationship has changed.
I guess so relative to my own work, I think that this work has certainly strengthened my understanding of those variables. So all previous estimates were relatively imperfect. We had a $100 billion experiment run on household behavior. And the slices, of course, that I measured in the Nielsen survey, I'm measuring something like $20 million. I can't get a grant to run experiments like that on households. So the federal government did me a huge favor. And so we don't have anything that clean in the world before that. All the stuff we have before is trying to guess about what these expected changes look like. Most estimates prior to this estimate were somewhat smaller. Concentrating on low asset households, you could find very large responses, but the average aggregate response was generally estimated to be less. So these numbers have raised our understanding of how big those are.
I know you didn't include the multiplier effect and but not that Mr. Krugman needs defense, but this implicitly kind of supports that the stimulus was way too small for the economy.
It is true that if you start building models with households that behave in this way, i.e. they spend in response much more to cash flow than to the expected present discounted value of all lifetime wealth, that you will tend to have models that deliver larger multipliers. The question really for this particular incident is, would this have had any saving effect for the run on Lehman and the financial crisis part of things? And that's a very different, I mean, but then I did this survey and then ended up going to the Treasury Department to kind of work on the Office of Financial Stability. When David said I worked in the Office of Financial Stability on TARP-related issues, I wanted to clarify that was 2009, not 2008 or 2007. So it's post-crisis that I was there. And then the cleanup, I mean, that's all, it's hard. I mean, certainly a stronger economy would have helped. Could it have helped enough? I don't know.
It's kind of a naive question, most probably. Since this benefit that was given, it's all, I'm assuming it is behind the scenes is printing more money. So why did the government not want to give 100 times more that incentive? Because it might have better and better effect, right?
Well, so behind the scenes is issuing debt. So the government, in order to send out all of the checks, this is the fiscal authority sending out the checks. It's a big increase in the deficit, which is financed by issuing more government debt. And so the flip side sort of concern would be, had the crisis not happened, we would have borne significant interest costs of this additional debt. Those interest costs would have been borne by future taxpayers, and that would have slowed the economy substantially in the future. So that's the concern, that if you do deficit spending in the bad times, you're going to end up with higher taxes or less government spending on roads, education, tanks in the future, and that has real costs.
Did you consider at all the effect of spending the ESP 150 billion on building roads or subsidizing municipalities so that teachers wouldn't get fired and all those options?
Yeah, there's sort of a couple of policies that followed on that people have tried to evaluate. So of course, after Lehman went under, we had the American Reinvestment and Recovery Act of 2009 that sent a lot of money out to states and localities to try and preserve their spending level. So many states and localities, when they saw the revenue collapse, faced balanced budget constitutions, for example, that required them to cut back spending, even if they thought it was a dumb idea, or to raise taxes, even if they thought it was a dumb idea. So the government was able to transfer money to them. Now, as it happened when the crisis came, the government was not debt constrained. So a big concern would have been, any other economy in the world does what we do. So they originate all the assets that cause a major financial crisis. They reveal that their financial system has credit rating agencies have signed off on this, and the whole thing goes up and down. And a bunch of their banks are wildly undercapitalized. And the government deficit is ballooning and debt rising rapidly. They do that, the value of their currency falls, and the interest rates shoot way up. In the United States case, everybody said, oh, the world's more dangerous, better go to the safe haven, the United States. The interest rates come way down, the exchange rate gains a lot of value, and the government can issue as much debt as as they want. So when it came time to do the American Reinvestment and Recovery Act, there was actually free financing for it. And so at negative real rates. So there was not a constraint at that later point. But that gets to the question of why not do this at a really big scale at the slightest drop of a hat. And it's because there are these future tax burdens. Now, it turns out that in this case, the tax burdens are actually going to be very small because of the very low cost of debt. But we do have, at the moment, we have totally accumulated a massive amount of government debt that will come with very large interest rates when they start to rise again. I mean, I didn't quite answer your question. So you said, why not choose a different way? So the other answer to that question is we have some research on what, for example, road spending does. And it tends to enter the economy with a much longer lag. So it's because the process, even the shovel-ready of 2009 took a long time to get out into the economy, the actual spending. And so that's a very difficult way to act quickly. Here, the law was passed in February, and the checks were going out in May. So that's phenomenally fast. And the one thing that you want for economic stimulus is for it to be timely, because recessions typically last 6 to 9 months. Now, we had a much bigger one this time. And so if it takes you 6 months to get and you often don't know you're in it until a month or two in. And so if it takes you 6 to 9 months to get the money out there, then you kind of missed the boat. You're feeding the recovery, you're not fighting the recession. And so one of the things that this program has going for it is it can act not quite as quickly as monetary policy, but phenomenally rapidly relative to all other sorts of actual government purchases.